Hi, good morning, and welcome to the Capital Grounds podcast. I'm your host, Nick Miller. Got my co-host here, Joe Fisher, and we've got our special guest, Calvin Roberts. I'll let Calvin introduce himself here in a few moments, but we're with SITG Capital. We are a real estate investment firm currently based out of Texas. We've got properties in Dallas, Houston, Austin, and a number of deals all over the place right now that we're exploring. So we're here to talk to you about real estate news, talk to you a little bit about coffee, and talk to you about today, insurance and why insurance
Mhm.
premiums are going up. But gentlemen, good morning. Thanks for joining us. How are you today?
Morning. I'm
Good.
doing excellent.
Yeah, morning. Thanks for having us.
Yeah. Thanks for being here. Calvin, if you could, introduce yourself to our listeners and our viewers. Tell them a little bit about your background, where you've been, what you've done, and we'll dig in.
Excellent. My name is Calvin Roberts. I'm the principal of an insurance brokerage called Falcon Insurance Agency of Michigan, based in downtown Ann Arbor, Michigan, home of the Michigan Wolverines. We're licensed in 41 states and counting, hoping to be fully national before end of year. Quick background on myself. I've worked in retail property and casualty insurance effectively my entire adult life. I started when I was 19 years old and stuck with it. It's been a fantastic industry to be in terms of growth and, really getting to where I would like to be.
Good for you. Good for you. I mentioned to you, Calvin, that generally we like to start these conversations off with some coffee. I've got my trusty tiny Yeti here, but uh, you mentioned you've got a cup and a story behind it. We'd love to hear what you're drinking
Ew.
this morning.
So this is my pineapple cup. A little bit of background on this. During
Mhm.
COVID, working from home, being at my desk and having YouTube up on my TV pretty much constantly. My girlfriend managed to convert me to the vegan lifestyle. And I know
Oh
that
man.
might ruffle just a few feathers, but
Oh, I don't think so.
after about a month of it, I think it was for the 30th day. It's kind of
Uh-huh.
congratulations. She got me this pineapple coffee cup, which I thought was pretty cool.
That's neat.
That's awesome. Good for you. I don't think it
Yeah.
ruffles any feathers. I think most of us are just curious how we would do with that. And all I can say for myself, I feel like I would probably fail trying to make that switch. So
I gotta tell you, they have come out with some amazingly convincingly real meat-like products over the last 5 years.
yeah.
And it's not the same thing, but it scratches like 85% of the itch. So it's surprisingly doable now.
Yeah, much better than it used to be, I'm sure.
No tofu in this household.
Wow, good for you. And it sounds like you've stuck with it then.
Yeah, no, I after maybe 6 months, you kind of just get used to it.
Yeah. Yeah. Makes sense.
Yeah, well, I think sticking with it for 6 months, I think that would be difficult for me. So props to you. Good for you.
Thank you.
And do you drink a lot of coffee? Is coffee something you enjoy?
Oh yeah, got my Keurig in the kitchen. We have a French press, which I used to
Nice.
use a fair amount. I get a little lazy and just go straight to the Keurig more often than not.
Yeah.
So we're caffeinated round the clock, ready to go.
I'm the same way. I like the idea of the French press. It makes pretty tasty coffee, but it's a bit more time consuming than I need. But I was using a Keurig there for a while, but now I've gone to a pour over, which isn't
hmm
quite as quick and easy as a Keurig,
Mhm.
but it's almost as easy, and I think it tastes better than at least what our Keurig produces. So. I can appreciate the struggle to make a solid cup every morning though.
So what got me into the French press years ago, I
hmm
had a roommate who he was finishing up a MBA at the University of Michigan. He was an international student from Madrid, Spain, and every morning he'd be out there in the kitchen with his French press, just rocking and rolling at 7 a.m. So there'd usually be enough
That's
left
awesome.
over to where, I'd say,
Yeah, it is.
let's do it.
Nice. Well, Joe, what do you have?
Yeah.
What's going on in your markets? What's going on in the current events? You're usually our current events guy.
Yeah,
Tell me
sure.
what you've,
Sure.
yeah, what you're seeing.
I mean, there's lots of interesting projects coming, things like that. But I figured I'd highlight two kind of larger aspects that speak to Texas, because like Nick mentioned, we're primarily concentrated in the three major markets in Texas, the Texas Triangle, we like to call it, right? So
Right.
Texas just actually ranked as the best business climate for corporate relocations or corporate expansions. So there was some interesting data points behind that, but basically since June of 2015 until now, there's been 284 total headquarter relocations. And what
Wow.
I thought was even more interesting about that, because if you guys live in Texas, you get a lot of people that complain. I'm not one of them, but complain about people coming from California. Of those 284, 144 were California
Wow.
companies that relocated to Texas. So I thought that was interesting. It kind of tied into a report that, and I don't know how credible this is. It's from a moving service called Move Buddha. So I really don't know where they get their data. So I'll preface it with that. But they're saying by 2100 that if migration trends stay the same, Dallas will be the largest city in the US. Houston will be number 2 and Austin will be number 3. So who knows? I mean, there's going to be changes between now and then, but I think that just illustrates, look, there's jobs coming consistently. And so, it is pushing people to migrate primarily to those three metros in Texas, and, helps from a real estate perspective, but also from a supply perspective. We don't have enough and we won't. So I think it just, continues to back our thesis.
Yeah, fair enough. Fair enough. And I think you made a fair point. A lot can change in the next 77 years, right?
Right, exactly.
But it still speaks to the trajectory that Texas is on right now, and the amount of, I think it really speaks to the massive inflow of people that we've got going on.
Yeah. Well, now we're in dead of summer right now, so we're hitting triple digit
Oof.
heat, every day. And we know the numbers behind the Sun Belt, and the Sun Belt's just, it's hot as can be right now. So sometimes I wonder, are people going to get fed up with that at some point? I don't know, but we'll see.
We'll see. We'll see. Calvin, you're in the, I'm not going to call it the far north, but relative to Texas, you might as well be Canada, right? You guys are just starting to hit the nice streak of summer, right?
At long last, Michigan is, how do I phrase this? We have 7 to 8 months where you don't see the sun. You're outside of your home or office while commuting from your home to your office and so forth, and that's about it. So we're finally getting into that short 3-4 month season where you can actually go outside, do things outside.
Yeah.
I mean, it feels like it never lasts long enough and takes too long to come in the first place. But then it gets up to, I don't know, 90, 95 degrees with 70, 80% humidity. And you're like, okay, well, I think I might be ready for the fall and winter again.
Yeah, fair enough.
Well, Calvin, I don't know if I mentioned this before, but I just moved from Minnesota here in the last year. My wife and I lived up in Minnesota for just over 4 years and fell in love with it. Even though, for us, there was maybe a 2 month period there, January, February, where, the cold weather was a little unbearable. But gosh, the rest of the year we just thought was fantastic. So I can appreciate some of the weather you've got up there, but I think you guys get quite a bit more. You've got some stronger effects there being so close to the Great Lakes.
Oh yeah, we joke they're the big bathtub. So especially on the west side of the state, you'll get
Yeah.
pounded with snow when it does come. I mean, it's not
Oh,
uncommon
yeah.
in Grand Rapids to get a foot plus of snow. So thankfully on the east side we get less of the lake effect. Not none, but overall it's Ann Arbor's a pretty nice area, and I'm happy with it.
Yeah.
I
Never
I
been,
think
but
we've
I've heard good things.
I think my wife at least has seen the extremes on the other side. She lived in Marquette,
Mhm.
Michigan, up in the UP, and they have the third highest annual snowfall at 144 inches annually. So I don't think she's ever going to get, she's never going to move someplace that has too much snow compared to that. Goodness.
So if Michigan is Canada to Texas, then the UP is Alaska to Michigan.
Yeah,
It's
yeah, fair
just a
enough.
different world up there.
Yeah, fair enough. Fair enough. Uh, well, let's dig into insurance. So,
Yeah.
gosh, we've seen a lot of volatility, a lot of changes going on in real estate markets over the last, 3, 4 years. And really, I mean, if you want to look back on a greater scale, we've seen a lot of things happening in the last 15 years.
Mhm.
But really, within the last, I would say since COVID, there's been a lot of turmoil. We've seen a lot of prices change, costs change, construction materials, are always fluctuating. And now we've seen the cost of insurance just skyrocket.
Yeah.
Calvin, yeah, would love to hear your perspective on rising premiums and what you see as the drivers and how you see maybe some of the key markets that are affecting that.
I would say there are really 5 or 6 things that are driving the not just increasing cost of insurance, but the increase in increasing cost. I mean, just
Mhm.
the percent delta change seems to be
Mhm.
continuing to increase upward. And it's bad no matter which way you try to frame it. The first root cause would be the topic on everyone's mind, inflation. And a big part of that comes down not just to, some of the stimulus and direct financial responses from the US government during the
Mhm.
COVID era, but also, things like the very low interest rates we had during that period driving inflation. So when the cost to rebuild a property increases 40, 50, 60% in 3 years, the cost of your insurance is going to scale fairly one-to-one. I mean, it's an increase in exposure, therefore your premium will increase proportional. The insurance premium pricing is exposure times rate equals premium. So if the exposure is continuing to increase, your premium is going to scale fairly linearly. I would say the second primary cause, especially in markets, really I'll address the kind of wolf in the room that everyone's thinking about Florida. Florida has a
Mhm.
multitude of things working against it. The first is that as a state, they've been generally hostile to the insurance industry for many years. And I'll elaborate on that, but things such as the friendliness and availability and borderline incentivization of encouraging insureds, the general public, to bring suit against their insurance company if they get a claim settlement that they don't believe is overwhelmingly in their favor. And you
Mhm.
combine that with very stringent rebuild requirements and the availability of, people such as public adjusters and door knocking contractors in markets like Florida, you have a pretty big problem. The second cause that's really driving the increase in cost of insurance is that many of the kind of core multifamily insurance players who have been in that world for many years are pulling out. They've had
Yeah.
a bad time really over the last 10 years, but especially over the last 5, where their loss ratio on the multifamily, the habitational segment, they can't get it under control. They can't take rate fast enough to account for the expected losses over the next year. And what do you do if you're a business and you keep losing money? You
Mhm.
go be a business doing something else, or you won't continue to be a business. So that's
Right.
really what we're
Yeah.
seeing. I saw that earlier this month, Nationwide, who have been one of my core multifamily markets for years, they
Mhm.
are putting the brakes, at least temporarily. We'll see if they come back to multifamily insurance on new business. They're not writing any new multifamily as of June 30th. that's concerning.
Wow.
I mean,
Yeah.
we're trending in a direction where all of the attractively priced, they call them admitted markets. So that's like your
Mhm.
Travelers, your State Farm, your Nationwide, all of your kind of
Sure.
core conventional players, they're pulling out of the market. So
Hmm.
when the admitteds pull out, you then have to place with a excess and surplus insurance company, your Lexingtons, your Scottsdales, your Century. It's bad. And I think it's going to continue worsening for at least the next 1 to 3 years. We'll see beyond that. I think eventually you'll see rate increase enough to where it will attract capital back into that market and people will begin
Sure.
to get over it again. We're in what's called a hard market right now in insurance. And basically what that means is it's a seller's market. They're able to
Mhm.
dictate terms, pricing, coverages. It's kind of a beggars can't be choosers scenario. And
Sure.
really, ironically, because of the way that the federal interest rate has increased over the last year and a half,
Mhm.
that is reducing the amount of capital available in the reinsurance markets. Reinsurance is insurance for the insurance companies when
Right.
a hurricane blows through or a really bad hailstorm affects an entire region all at once. Stuff like that, the big catastrophic loss events that insurance companies don't want to have to reserve for. They'd rather buy reinsurance and allow for more efficient use of capital throughout the
Mhm.
risk capital stack. Because of interest rates increasing, just one of the unintended consequences is that has reduced the amount of capital available for reinsurance products. So you're seeing an increase of risk, a decrease in the amount of total reinsurance coverage capacity available. Those two things in tandem means that your price is going to go up. So it's not just the
Yeah.
exposure increasing due to rising rebuild costs, but also the rate that you pay is increasing. And you see that even more so in markets like Florida, where, I mean, it doesn't really matter or seem to matter what premium people are paying in Florida. Insurance
Mhm.
companies are still losing money. They're going insolvent
Wow.
constantly. I mean, just
Mm.
last
Wow.
year we saw something like 15 insurance companies fail out of Florida, where they either
Wow.
went insolvent or just completely exited the state.
Yeah.
It's not good.
No, not at all. Not at all.
Man. Yeah.
Getting squeezed on both ends of the equation, it sounds like.
Yeah, no, it's rough. I feel for my investor clients. I mean, I look
Yeah.
at some of the renewal increases anymore, and I see 18%, 20%.
Mhm.
I think, oh, good. It's only 20%, no big deal.
Right. Right.
So,
No, I can tell you, Calvin, I mean, just looking at deals and not just us, but other people we know in the industry, right? Insurance in some cases is completely killing deals.
yeah.
Because they just can't. It doesn't make sense, if your premiums are going to be that high, it really affects your revenue, really affects your just overall pro forma and what you can actually get that property to do from a performance perspective.
Absolutely.
Yeah.
I think until some of the debt begins to renew over the next couple of years, you're
Mhm.
seeing a lot of properties on the market where the seller doesn't necessarily have to sell. So they're
Right.
throwing out a number in their T12 and on their seller pro forma. That's an imaginary number for the cost of insurance. I mean, it just isn't achievable.
Right.
And, maybe that is similar to what they're paying right now. But, if they've owned that apartment building in Florida for, I don't know, 15 years,
Mhm.
do you think that they have been going through with their insurance broker every year to increase the building limit proportional to what it should cost to rebuild the property? Or do you think it's just kind of on autopilot, set it and forget it? Maybe they try to shop it every couple of years
Yeah.
and just never find a better deal. Well, if you're insuring a property for 40% of what it costs to rebuild, one, that will trigger co-insurance penalty. You're not even going to get the 40% if a loss happens.
Oh, wow.
Two, if you try to shop that on price,
Mhm.
you'll never find anyone who can win it on price on new business because of it's a simple equation. Exposure times rate equals premium. So if your
Right.
exposure is half of what I would bid, my rate has to be less than half.
Wow.
And that doesn't make sense.
Mm-hmm.
Yeah.
It's rough. I mean, I think we'll begin to see a greater abundance of deals over the next year or two,
Mhm.
but we'll see. I mean, it's a weird time right now in the multifamily game.
Yeah, definitely. Definitely. That's not the only factor, obviously. I mean, rates probably number one, but insurance to me is probably, number two reason why deals aren't getting done. So,
Oh, absolutely.
And it's such an unknown, it's such a variable that is tough to predict the future of.
Mhm.
But hopefully, like we're seeing in a number of other places, with rents anyway, where the cost of building has gone up and there's a housing shortage, the I don't know if it's the beauty of open markets, but the great thing about economics is that they will rebalance, right?
Mm-hmm.
Something will happen, whether
Mhm.
it's, in my example, rental rates coming up to where it makes sense to build, so in this instance, hopefully, I mean, on the probably bad for us, but maybe premiums will go up far enough that more people will, will have more supply enter into the markets, more insurers. But until that happens, we're kind of, we're at the mercy of the moving numbers right now.
I think about let me rephrase that. What I believe will eventually happen in those
Mhm.
catastrophic exposed markets like Florida and the Gulf Coast and some of the more wildfire prone regions over on the west side of the United States, I think you'll see the federal government come out with something similar to the Terrorism Risk Insurance Act, where after 9/11, terrorism cover was essentially uninsurable for the private marketplace.
Mhm.
9/11 caused, I think, 3 insurance companies to go insolvent, not just because of the building property loss, but the spider web of cascading liabilities that arose as a result, where it's,
Right.
the tenant suing the property manager, who's suing the building owner, who's suing the contractor. It was messy. So Congress, with their infinite wisdom, responded with the Terrorism Risk Insurance Act,
Mhm.
which effectively is the United States federal government acting as a reinsurance facility for that terrorism cover. So the private insurance marketplace really just acts to distribute that cover. The private marketplace retains about 15% of the risk. The other 85% in the terror loss scenario is picked up by the federal government. I think you'll see something similar with catastrophic property loss risk.
Right.
And I think back to a quote from Hank Paulson, who was I think, Secretary Treasurer, high up in the Treasury Department during
Mhm.
the Great Financial Crisis, that markets aren't always self-correcting. And I think that's what you'll see in the property market, that if you're the US federal government and you don't want to discourage continued development in places like Florida or North Carolina or
Mhm.
Alabama, you don't want it to become impossible to secure insurance at a cost-effective price.
Sure.
You don't want that to be a prohibiting factor that spooks development, pushes it outward. So you'll subsidize that to keep those sweet federal tax dollars coming in from those regions. I think it's the least painful approach at this point. Will it solve the problem forever? No. But will it
Right.
kick the can 20 to 40 years? Probably. So I think that's what we're likely to see over the next decade.
Yeah. Interesting point.
Yeah, I think that's a great point. I mean, that's a great point. Um, so, I think that brings us to things that we can be doing now
Mhm.
to reduce our premiums. You've mentioned a couple of great suggestions that would love if you share with our viewers, but what do you see, as an insurer, what do you see what tips and tricks, could you pass along to us and our viewers to help reduce our premiums in the meantime while we manage what we can?
So the first one that I actively push on to all of my multifamily operator clients is secure the tenant legal liability angle. So that is, the tenant falls asleep with something in the oven, causes a fire, does 100 grand of damage. Those incidents are low to medium severity, high frequency types of losses.
Mhm.
We don't want that to be a claim on our insurance policy that maybe gets us non-renewed. We have to go to a higher priced, more friendly to loss prone account insurance company. We want that to be a claim on the tenant's insurance, either their renter's insurance policy or a master program for the tenant legal liability that we control, but then charge back to the tenants. That has, in the abstract, reduced costs for my clients more than just about any other approach. And it's tough to give an exact dollar amount in savings because it just depends on that unknown variable of the losses you might incur in the future. But I can tell you that just over the holiday season, last week of 2022, where in Michigan and most of the upper Midwest, it got down into the negative teens and 20s.
Mhm.
I had quite a few of my clients' tenants out of town for the holidays, and they thought, oh, I'll save $10 on my electric bill. Let's turn off the heat while I'm gone. And they come back and the pipes in the wall have exploded. And saw a lot of that. And I
Yeah.
had probably about a half dozen losses that did not go onto my property owner's property policy.
Wow.
They went on to that tenant legal liability program that we set up
Mhm.
for them. So did it save them money on their next insurance renewal? Possibly, because they didn't get non-renewed and have to go to a uglier insurance company to get the job
Right.
done. But it's more of an abstract and save you money. It prevents that future massive increase rather than it reduces today's expense 10% kind of thing.
Sure.
What do they say? A penny saved is a penny earned. Same
No, exactly.
concept, right? Yeah.
It really has been the first line of defense when it comes to multifamily risk management. It's
Mhm.
not the tornado that blows through. It's not the, hailstorm or another
Mhm.
catastrophic loss events like that seems to destroy the profitability in the segment. It's that low to medium severity, very high frequency tenant negligence loss where they just worked an 11-hour shift. They come home, open a 6-pack of beers, throw a frozen pizza in the oven, then fall asleep on the couch. I see that
Yeah.
one quite a bit.
Yeah.
I mean, if you can transfer that portion of the risk somewhere else, be it the tenant's renter's insurance policy or to a separate tenant legal liability policy that you then charge back to the tenant and passed on the cost of to the tenant,
Right.
it'll do a lot for you.
Yeah.
And we see that a lot in other markets, that it's death by 1,000 cuts that causes the most damage.
Mhm.
And I think you hit the nail on the head. Right now, we're going to have to be very, very precise, with laser focus on really defining clearly through legal documents what liabilities we'll take on and what we'll pass on to our tenants. Because I mean, at the end of the day, that's what the insurance world is all about, right? Is divvying up and passing along what risks you can to other parties. So that's a great point. That's a great point. I hope anybody listening writes that down. What other items do you see? You've mentioned a few more that I think are really good that I hope you share.
So I'm a big believer in contractual risk transfer as frequently as possible, be it something along the lines of, having strict subcontractor minimum insurance requirements. So we hire a landscaping or a snow and lawn contractor or a roofing contractor. And, maybe the landscaping contractor messes up when they're de-icing your parking lot and a tenant slips and falls and then brings suit. We don't want that to be a claim on our insurance policy. We didn't really cause the loss. That's where having strict insurance requirements for the subs that we employ comes into play. We want their general liability insurance to have us as an additional insured. We want their policy to have a primary non-contributory condition, which means that their insurance will agree to take point. They won't try to get into excuse my language, but a pissing battle with us and our insurance company.
Sure.
Yeah.
Sure.
We want that waiver of subrogation so that the contractor's insurance can't try to, after they pay the claim, come pointing fingers at us like, oh, you were, contributing to the negligence because of reasons X, Y, and Z. So give us this bag of money back. It doesn't cost you anything to require that of your subs. And truthfully, most subcontractor, let me rephrase that, contractor insurance in general will have most of these conditions baked into the policy. At least that's how I typically write my contractor accounts.
Right.
But they do require that contractual requirement of the subcontractor to provide them to the hiring, in this case, the GC, for coverage to trigger. It requires that contractual requirement for the subcontractor to provide those conditions. So I recommend chatting with your insurance broker, your attorney, anyone else that, you feel is qualified to give risk consultation, more or less, and pick up any elements that you believe are necessary and diligent for your operation. Another example of that might be in our tenant lease agreement. Does your lease explicitly disclaim liability from loss to the tenant's personal auto parked on premises? A tenant has their car in the parking lot, it gets stolen or banged up. Maybe they missed their insurance payment that month and coverage lapsed. We don't want them to come pointing fingers at us. And I've preached on that for probably 3 years. I picked that out of a case study I did on McKinley Properties based in Ann Arbor. They have 36,000 doors in Ann Arbor and Orlando, and they've been around the block for 6 decades. So I figured they've probably been sued and quite possibly lost or just agreed to settle to be done with it.
Sure.
Never again. That's something I found in their tenant lease agreement that made me think, that makes sense. And
yeah, that does.
Anecdotally, maybe a week and a half ago, I saw a post on Facebook in a local community Facebook group of someone who had their vehicle vandalized on premises and was pointing fingers publicly at the landlord, was seeking counsel advice. People will spend $2,000 on attorney bills to avoid paying a $1,000 comprehensive deductible on their insurance. I don't really get it, can't wrap my head around it, but it's the nature of how things are.
Yeah.
So
yeah.
It's good to expressly disclaim liabilities you feel are not your responsibility as the property manager and operator of the property. Will they stick if it goes to court and it's challenged? I don't know. I'm not an attorney. I can't really speculate there.
Yeah, of
But
course.
if it does go to court, it's something that we can point to and stand behind. Well, the tenant signed here. It's a lot better to go to court with that in your back pocket than, we don't feel reliable and just nothing in writing that the tenants agreed to.
No paper trail, yeah.
Exactly.
Yeah.
Yeah, fair enough. I think at this point we're trying to, like we talked about earlier, just reassign some of this risk to other parts of the insurance market, right? Whether it's, I mean, I don't know enough about insurance to really speak intelligently here, but reassign some of this risk from the multifamily insurance world to like the auto world or the renter market world, which may be tied into multifamily. But I think what you're saying makes a lot of sense, and being diligent reviewing these documents is probably worth time and money to at least make sure you're doing what you can to pass along that risk to other more appropriate parties, I would say.
Exactly. We're not trying to wipe our hands of all losses, just the losses that are not directly our responsibility. Those should be contractually passed on to the other party.
Right.
Yeah. So I have to say one thing, and one thing I do want to talk about with you is we hear this a lot, a buzzword out there. You've got a lot of operators that, they'll claim this because they're trying to get investors on board and trying to get them to understand, hey, we're in a good position when it comes to insurance. But captive has become a very popular thing in the last, since I would say year or two, that everybody's trying to do it. So I would love to kind of get your perspective on that. And, for some of the smaller operators, if there's anything they can do similar to that, that might save them some money. But, kind of give us a little bit of insight on how that works and what you need to look for, in order to make that something that's viable for your business.
So captives are definitely a dangerous tool to keep in your toolbox for multifamily insurance. They can be extremely effective at controlling cost and normalizing pricing within your operation. They don't work for probably 99.9% of multifamily operators. It's that very large organization that has realistically probably 1,500 plus doors. Kind of depends on which market you're in, but if you're not paying at least $1 million in premium, I haven't found captives to be the most economic vehicle for transferring risk. But if you are sufficiently at scale, they can be extremely useful in terms of normalizing your insurance premium and being able to better control. And it's not so much that they will on day one give you a massive decrease in your insurance cost. It's that over the next 10 years, if your loss performance, your claims history is significantly better than benchmark, you directly benefit from that diligence. So it allows forward-thinking, prudent, risk-focused groups to directly be in the driver's seat of their risk control program. It definitely does have a place, but I don't think it's the most effective vehicle if you're realistically paying anything less than $1 million, maybe 1.5. Below that, it just seems to the year one increase in cost doesn't seem to be worthwhile for most groups because you also have to buy reinsurance for your captive unless you have a massive reserve established, and just doesn't seem to be the most efficient and advantageous use of capital for the smaller groups. But if you're a big firm, it's worth looking into and running a feasibility study, if nothing else. You don't have to pull the trigger, but just see if it might make sense and if it is aligned with your goals and really your loss history as an organization. But if you're thinking to yourself, I pay $2 million in premium and we've had 600,000 in claims over the last 3 years. Insurance companies are making all this money on me. It allows you to more or less put your money where your mouth is. You can become the insurance company as the owner of the captive. So you dip into, the underwriting profit that's created. You dip into the investment income profit that's generated from the float mechanism. It can make a lot of sense for a sufficiently at scale group. And if you're not to that fairly large scale, there are some other interesting approaches. You could get into a risk purchasing group. That's you and 10 of your similar buddies. They all have similar-ish operations and similar-ish markets. Think of it as a custom insurance program based not so much just on the industry that you operate in, but also this group's loss performance in aggregate across the group.
I gotcha. Yeah.
There are some interesting RPGs available, and occasionally we do try to place into those. The Bolton Street programs, I do a little bit with them. There's one out of Texas, I forget what it's called, but I've run their paper multiple times. There's a very interesting RPG in the Midwest on American National paper. You see that one occasionally. They can make sense fairly occasionally. RPGs don't fit for every group, but they fit for more groups than a captive approach typically will.
Yeah, that makes sense. Yeah.
Well, and out of curiosity, for our viewers that maybe have the capacity or where it makes sense, can you give us insight into the basics of setting up a captive program?
Absolutely. So we would book a meeting with 1 to 3 captive management consulting firms, and I would essentially run the show on getting us from the early pre-planning stages to the implementation and then eventually operation of the captive. So it's really a step one of meet with a captive consulting firm. Step two, run a feasibility study and see if it even is practical or makes sense before we invest too much time and money into this. And then it gets fairly complex from there, depending on things such as, who your loans are through, what kind of requirements they have. We might have to arrange it's called a fronting carrier relationship. So that's where your captive would technically be the reinsurer of the primary company who would put up the paper, as it's called. So they have admitted or otherwise A-rated paper. They're an A-rated company. So it would be accepted by your lender. They put up the paper, we reinsure them for losses. We might pay a 5 to 10% premium to the fronting company for putting up their paper. And then once you're, fully implemented, my function as the retail insurance broker is not dissimilar to if I had just written you with a fairly conventional insurance product, certificates, risk consulting, things such as that. It's pretty similar-ish from that point, at least from my perspective.
Fair enough.
Gotcha.
Fair enough. Just a bit more heavy lifting on the front end to make sure that it makes sense and get all of your ducks in a row.
Exactly. It's a solid 6 to 12 month process to get a captive off the ground.
Yeah. Right. Right.
Yeah, fair enough. Fair enough. Okay. Well, excellent. Well, gosh, Calvin, I think this has been quite educational, quite informative. Thank you for sharing your wealth of knowledge with us this morning.
Yeah. Thanks,
Joe, do you have
Calvin.
any last minute items, Joe, for Calvin? I don't have any. Do you have any?
No, I mean, it's always, informative to kind of hear somebody in your world talk about it, because again, for us, it's just it oftentimes is just a variable that we don't have a ton of control over, or at least that's what it feels like, right? So it's good to hear some of the things that we can actively do and be a little bit more proactive when it comes to insurance. And yeah, I really appreciated your take just overall on what you think is going to happen and in general, because again, like I said, for me, I'm seeing deals getting killed, number one, because of rates, of course. And then number two, it probably there is insurance. So it's a big deal right now, and lots of people are talking about it. So I appreciate you sharing your knowledge.
Oh, likewise. I very much appreciate the opportunity to speak with yourself and Nick, and had a great time today.
Yeah, and Calvin, for our viewers and listeners, we'll include his links to his website below, his contact information. If you've got questions, if you want to get in touch, certainly check out those options. Reach out to us. We're happy to connect you. Calvin, do you have anything that, any last minute comments, thoughts for our viewers and listeners that maybe we haven't covered so far?
If you are ever wondering what could the insurance premium be for a deal that you're underwriting, shoot me a message. I can get you a indicated range based on the base property rate, so the dollars in premium that they charge per 100 in building coverage, within maybe 2 hours every single time. It's
that's great.
I try to estimate a little conservatively just to make sure I'll be able to hit within the range that I'm indicating, but they're pretty on the money. So I'd love to be a resource for any deal underwriting or anything like that we might run into.
No, we appreciate
Excellent.
that. That's great
that's
information.
great.
Real quick, what are the you said there's 9 states that you're not in yet. What are those right now?
Wyoming, North Dakota, South Dakota, Idaho, pretty much like the rural, not Northwest, but like
Uh-huh.
desert northern or like mountain northern west. So north of Colorado until you get to like Wisconsin, basically. Oh, and
Gotcha.
Hawaii and
Okay.
Alaska. Can't forget about
Okay.
those two.
Yeah. Hey,
Are
well,
you
you're in
are you
Texas, man, so you're good.
are you in Minnesota?
Not yet. So I've expanded our licensing on kind of a need basis, and I just haven't had many deals come up in Minnesota yet. I had a client underwriting one, oh gosh, maybe a month and a half ago now. So it is on
Mhm.
my to-do list over the next quarter, is round out the remaining licensing that needs to get done. Most states make it pretty easy. Some states like to challenge you seemingly just to keep things spicy. Looking at California.
Fair enough.
We're getting there.
Oh, that's
Well,
great, man.
excellent. Well, I appreciate your time with us this morning. Joe, always good to chat with you. Calvin, would love to have you on the show in the future. If you've got anything interesting from time to time, certainly give us a shout, and I'll be checking in with you once in a blue moon, make sure things are going well. But if you haven't, viewers, listeners, if you haven't checked out our website, check it out, sitgcapital.com. If you've got comments, thoughts, questions, things you'd like us to cover, send us an email, give us a call, leave a comment, whatever it takes. Reach out to us and we'll make it happen. So everybody, thank you for your time, and we will look to see you next week.
Thank you.
Thanks,
Take
Calvin.
care. Bye-bye.
Thank you again.